Welcome everybody, this is Buck Joffrey with Wealth Formula Podcast. It's the Wealth Formula Podcast, yes indeed. And today, let me just start by reminding you that I have this course released. It's called Your Roadmap to Real Wealth. So, faculty include Rich Dad Advisors, Tom Wheelwright, Ken McElroy, guys like International Asset Protection and Estate Planning Attorney Kevin Day, the real estate guys, Dean Graziosi. I mean, that's just to start. And this is a really robust course. And for those of you who've said to me, where do I start? Where do I get the foundation? Well, listen, you want to know how I went from being broke, literally like negative net worth, in 2008 when I finished my training, and then in 7 years ended up with an 8-figure net worth? Well, it's in large part because of the people in this course, and they are going to teach you what they taught me, and then I also teach you everything that I've learned on this journey unlocking the secrets of the ultra wealthy. So sign up for that course, and also for a limited time there's also a free membership to Wealth Formula Network, which is going to be the Wealth Formula community online. Let's start growing your wealth together. Go to wealthformularoadmap.com and sign up. I should point out that a number of people were very interested in something that I had offered last week, which is a 1-hour personal coaching and wealth strategy session with me. And so that was, I'm going to extend that now. Just to make sure that anybody who's really interested in that has an opportunity. But you have to sign up before April 14th. Before April 14th, right? I didn't say Friday the 13th on purpose. So sign up before April 14th, and you will also, in addition to this fantastic course and access to the Wealth Formula Network, get a one-on-one consultation and coaching strategy with me. Now I have to warn you before you go and get this kind of consultation that I'm going to make you do a lot of homework if you end up with one of these consultation sessions, because I do not take these types of things very lightly. I don't do them very often, but when I do, it needs to be rigorous. So it's going to start out with some homework. It's going to start out with some reflection. I'm going to even ask you to draw pictures, etc. But it's what I do. I mean, it's what I do on a regular basis, and that's what this whole session is going to be about. Now, this course, which is called Your Roadmap to Real Wealth, is about unlocking the unfair advantages of the wealthy. And again, you can go get it at wealthformularoadmap.com. Now, while most of us high-paid professional suckers, as you might call it, let Wall Street convince us we should be happy getting 5 to 7% growth on our money, yippee, right? Well, the ultra wealthy don't buy it. No pun intended. Well, actually, there was pun intended. Because you see, the ultra wealthy know that there are opportunities out there constantly to amplify their money exponentially. And one of the reasons, personally, that I don't like investing in the New York Stock Exchange is that by the time a stock becomes publicly traded, most of that upside is already gone. There's very little meat on the bone, only about 5 to 7% per year worth of meat on the bone at that point. You know, let's take this company Square, Inc., for example. You know, this company, you see this, they're a mobile payments company, and you see people using them all. You know, you can basically take credit card payments on your phone, whatever. Sometimes you see them in small businesses, but that's Square. And it's a software firm. It basically allows pretty much anyone to take credit card payments. That's in effect what it is, and it's a nice idea. And sure, I don't doubt that this company has a bright future. But let's look at, if you wanted to invest in this company, you know, buy stock in this company or equity. When you look at the stock, its price to earnings ratio is, well, it's over 1,000. Okay, so what does that even mean, price to earnings ratio? Well, it's a ratio, right? It's the price divided by the earnings, and it equals 1,000. So let's give an example of how that would work. Well, let's say that you have a small business that makes $500,000 per year. I know there are many listeners of this show who are in that scenario for sure. And you decide you want to sell your business. And you want to sell your business for a price to earnings ratio of 1,000, just like Square. Well, that would mean that you'd put your business up for sale for $500 million, right? Who's going to buy that? Well, apparently people on the New York Stock Exchange are going to buy that. Now, are you really going to buy a company valued like that yourself? Well, that's what people do on a regular basis when they're buying publicly traded stock. Private companies don't typically have those crazy valuations. Why? Because the valuations are typically made by appraisals, and they're not made by irrational exuberance, right? It's not made by public sentiment of, yes, I think this one's going to go up. That doesn't really happen. There's a rhyme and reason for private companies to have appraisals that they do. And that's why the ultra wealthy, who often are able to invest in these companies before their initial public offerings, often make such a killing. The problem is that most of us, if we want to participate in this, don't have an extra couple $1 million to play with to speculate a little bit, even on, if you want to call it speculation. I mean, some of these are late stage private companies that are about to go public that you already know about. But now, what if you could, on the other hand, invest, $25,000 into a company like, say, Lyft, right? Lyft, you might know that. That's Uber's major competitor. It's actually a privately held company right now. But what if you could just buy $25,000 into Lyft before it goes public? Would you do it? Well, it might make sense, right? It might make sense. The problem is that, as I said, until recently, it was impossible for accredited investors who aren't worth several $1 million to participate in this world. And that is, of course, until recently. You see, I just discovered a way for high-paid professionals to play in the world that used to be reserved for the billionaire boys club, as they say. It's through a business called Equityzen. And when we come back, I have got the CEO and founder of this company, Atish Dabda, and he's going to tell us exactly how it works. Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is Atish Dabda. Atish is the founder and CEO of Equityzen. Part of Equityzen's mission is to allow investors that previously couldn't access late-stage private companies due to access and investment minimums, etc., to invest in private companies before they go public. So it's a really neat idea. Atish, welcome to Wealth Formula Podcast.
Good to be here.
So let's start out a little bit about, how did you get into this? Tell us a little bit about yourself and why you founded Equityzen in particular.
I studied anything related to numbers when I was an undergrad. Numbers just made a lot of sense to me. So ended up working at a hedge fund out of college. And then the entrepreneurship bug, which had bitten me many years ago, really took hold. So I ended up working at a small startup as its first employee in its new division. Long story short, you fast forward a few years, and I had gotten some equity, some shares from that company as part of my compensation. They were worth more then than they were when I first joined. And since I wasn't making the hedge fund salary anymore, and my girlfriend at the time was kind of tapping her wrist saying, "Hey, when's this thing going to move forward?" I started shopping around for an engagement ring, and I realized that the darn things are pretty expensive. So, I tried to sell some of this equity that I had, the shares that I had in that private company, and sure enough, even though everyone assured me that this paper money was actual money, I couldn't buy a ring with it. I realized I can't buy a burger with it, can't buy a house with it. So that was really the idea behind Equityzen. Equityzen is a place where buyers and sellers can get together and trade in private company shares, which is exactly the problem I had faced. And, about 5 years later now, we're really proud to have been able to help a lot of folks both get an engagement ring, pay for a wedding, buy a new house, and a few other great things.
Right, so it's great for people. I mean, there's people who are listening to this show who work for some of these companies where they're currently getting, a large amount of equity, as part of their compensation. So, you could look at this, those people can look at this both as an investor and also as a place to potentially, take some of that capital off the table and invest into something else. So it's pretty exciting. So, I have a lot of accredited investors listening to this show, but what we mostly focus on is, real estate or other things that the traditional markets would call quote unquote alternative assets. Can you, just so that we're kind of starting at the same page, can you give us a summary of how the typical company goes from being private to public and where Equityzen fits into this picture?
Absolutely. So there's a lot of there's a lot of ways to build a company. By far, a very common one, especially in the last 10 years, has become to go raise a small round of funding from either friends and family or angel investors. And then you go to a venture capitalist or another fund and you say, hey, look, I've spent the last year or two proving out my idea. I think it has some traction. Here are the numbers. I'd like to raise some capital in order to accelerate the growth. And you do that 3 or 4 times over. And then at some point, these private companies are the types of companies that you and I might have on our mobile devices, the Spotifys of the world that's about to list publicly next week, Lyft, the car sharing company, and so on and so forth. And by the time they get so big that they're ready to, what's called IPO or start being traded publicly on the New York Stock Exchange or NASDAQ, what ends up happening is that they're so large that they really focus on a small number of very large investors when they're ready to actually, raise the next round of capital. Now, that's a great strategy for those late stage companies because they, can't really take 1,000 people who want to put in $20,000 each. It's too much work for them to do to raise $20 million. But where Equityzen comes into play here is that when these companies are typically 2 to 5 years away from going public, so they're 2 to 5 years away from being listed on the public stock exchange, you and I can go on our Fidelity or Vanguard or E-Trade accounts and buy and sell stocks just like we can for Facebook and Google today. These companies are actually a very different type of alternative investment than early stage angel investing, which I think a lot of the listeners here must at least be familiar with.
Yep.
And so to kind of zoom out, if you think about a company's life cycle as angel investments or when the company's young and the founders are working on their laptops furiously in a coffee shop, in their diapers, the company is, and then when the company goes public, we're talking about the company graduating from college. Where Equityzen really tries to operate is when the companies are graduating high school, they're in college, they're a proven entity, they're a household name a lot of times, but they're out of reach for the typical accredited investor because the typical accredited investor doesn't write a $20 million check. They like to write $20, $50, $100,000.
Yeah, that makes a lot of sense. And I think that's where this is super cool because now I'm assuming that the real value of buying pre-IPOs, like we're doing here with Equityzen, is that the valuations aren't, that they're not bloated like they are once the stock goes public. There's more meat on the bone, sort of like buying wholesale instead of retail. Is that fair?
Yeah, I think a great way to think about this is to look at, what your wealth advisor is giving you access to. A lot of times our wealth advisors will tell us, hey, I've got this, great stock or a great set of stocks in the public markets. Or they'll say, hey, I've got this fund manager, this venture capitalist or growth equity fund that I want you to take a look at. What's pretty hard for these wealth advisors to do, and we certainly have many wealth advisors as clients on Equityzen, is what's pretty difficult for them is to be able to consistently and with the approval of the company, be able to get, what we like to call the retail accredited investors access, the folks that aren't writing, $1 million or larger checks all the time. And it's because frankly, it's a lot of work. And, by the time you've gotten 50 people together who are writing $100,000 check each, that can take anywhere from a month to a couple of months, and the company may have moved on by then, and the opportunity is lost. And so, what Equityzen really tries to focus on is companies that are still undervalued because they're private companies. People don't know as much about them. They haven't gone through the whole roadshow and the fanfare yet. And so they're slightly less known, but at the same time, they're well past the diaper stage where now they're generating tens of millions of dollars in revenue. I'll give you an example. One of the companies that Equityzen is particularly excited about, we've worked with this company, DocuSign, and as well as with Spotify, that's about to list publicly. DocuSign is a company that landed a contract to conduct all e-signature transactions for the U.S. government. And that's a big accomplishment, but DocuSign is not a public company yet. So if you or I wanted to go buy it on our Fidelity accounts, that can prove pretty tricky. And Equityzen has worked with DocuSign, its shareholders, and many incoming investors for many years now to provide them that access before the whole world knows about it and before the stock pops after the IPO. But after they've established themselves as having generated hundreds of millions of dollars in revenue.
Yeah, and that's where I think this is really cool. And just to clarify too, I mean these companies, when you go and you look, I got log in and I took a look around. I'm like, wow, some of these companies I thought were probably already were public. I mean, they were, these were companies that I completely knew of, that I was very familiar with. So it's not like these are, a bunch of no-name companies. Can you give us, just so that we have a sense of how this can go, and certainly understanding that, past performance is not indicative of future results, but can you give us some examples of some pre-IPO equities sold on Equityzen, and then maybe how they ended up doing after going public?
Yeah, happy to do that. And you're absolutely right. It's worth repeating that past performance is not a guarantee of future success, of course. There are two things I'd love to point out here. Number one is that what you said is actually a pretty common thing. There's a lot of companies that are just so large now, that are still private, that it really boggles the mind. And a big reason of for this is that the number of public companies in the U.S. is actually at a 40-year low. We used to have around 8,000 companies at the turn of the millennium that the average investor could invest in, and now that number is barely above 4,000. And that means that the same money that's going into the stock market is being concentrated in fewer and fewer names. And what that means for the private market, which is the market right before these companies actually go public, what it means for them is that the companies are staying private longer. That means there's more and more shareholders and their employees and their investors that have to wait longer to sell their shares. And we believe that this is a ripe opportunity for accredited investors to take a look at, because what's the point in waiting on the sidelines while waiting for this company to go public? There's a chance the company may get acquired, and as it happened with AppDynamics, one of Equityzen's partners, and then you never get a chance to actually buy into this company in the public market. So we think that there's a lot of opportunity here, and some of the companies that we're particularly excited about having helped is, since this is a real estate familiar audience, I'll point out Redfin. Redfin is a company that that's a public company now. Equityzen helped them with shareholder liquidity before the company had gone public. And what that did for Redfin was that it gave us their blessing, because it allowed a lot of their shareholders, their employees, their investors to get some liquidity, sell some of their shares before the IPO at a price that was a discount to the price at which they went public on. This also allowed a lot of accredited investors to access Redfin shares before the company goes public, again, at that discounted price. And it really is a win-win because the sellers have been holding the shares for so long. They got the shares when it was worth a lot less. And the buyers, they invested in this company before the IPO, and they're able to not only invest that frequently at a discount, but also have a longer capital gains holding period, which means that if they did want to sell their shares after holding onto it for 2-3 years, well, they could potentially do that 6 months earlier, 12 months earlier than that. Some of the other companies I want to just mention here is that we work with B2B companies such as DocuSign. We also work with B2C companies such as Lyft and Spotify and Nextdoor and Opendoor. And I think these are companies that a lot of the folks on the podcast will be familiar with, given the impact they've made in the real estate market.
Yeah, absolutely. I mean, even companies like, you said Lyft, we all know Lyft and, 23andMe and all these other interesting companies that we all know about. So there's an opportunity there. You mentioned a little bit about how people might be wanting to sell because they've held for a while and maybe they need liquidity. Did you say that typically it's about from the point at buying from Equityzen, it's usually probably about 2 years from IPO? Is that about average?
Yeah, it's about 2 to 4 years away. So we have companies that are. So first of all, I should mention that Equityzen only works not only with the company's approval for conducting these transactions, but also with companies that are at least $100 million in enterprise value on the small end. And Equityzen has partners, Lyft is just one of them, that are worth many, many times more than that. So some of these companies are worth, in the billions or tens of billions of dollars while they're still private. So these are not all, like fly-by-night companies. Now they're risky investments. These are equity investments. However, these are companies that are making tens or hundreds, if not more, millions of dollars in revenue every year. So the typical company that you might consider is, a company that's 8 years old. They've got 600 employees. They've had investors that have held stock in the company from year 0 all the way through year 5, 6, 7, 8, 9. And the investor, the angel investor maybe that put in $50,000 in a company, that $50,000 is now worth $500,000. Well, they may want to take some of that out and reinvest it into 5 new companies, while still leaving half of their $500,000 slot in there. And just because they're ready to sell some of it at year 6 presents an opportunity for someone else to come in and say, you know what, I'm ready now that I see that the company has proven itself a bit, to come in at year 6 and hold on to it until year 10.
Yeah, got it. So let's talk about this sort of mechanically in terms of, okay, the people selling, they're these angel investors or who maybe there's some employees who are looking for liquidity, which is, how do you get those, and how do you get those on your end? How do you get those shares, those equities, and how do you value them?
Yeah, so any accredited investor that comes to our platform, they can be sure of a few things. So the first and foremost, they can be sure that these companies are going to approve the transaction. If they end up actually buying the shares, they're actually going to be holding on to, like, the shares have undergone a lot of due diligence to make sure that when you invest into this fund, the fund will definitely own the shares. That's number one. Number two is that we take a lot of effort to screen out a lot of the companies that whose shareholders try and sell their shares, but they may not pass all of Equityzen's filters. And so Equityzen, for example, only allows 1 out of every 20 sellers to actually list their shares on the platform. And the vast majority of the time that these companies do actually pass our screens, will also have put together an entire investment document or a private placement memorandum that will be visible that specifically spells out, what the share price is, what the implied valuation is, what was the company's last round of financing, what the implied discount or premium is, what the entire history was of every single series of stock that the company has ever sold, and therefore their price along with all the rights associated with that series of stock, who the investors are of the company, what the business model is, everything we can publicly verify with regards to their financials. There's really a lot of information available on these companies. And frankly, this surprises a lot of our clients. And, we now serve over 25,000 investors from over 50 countries. And a lot of these investors, they write into us and they say, I'm really surprised to find this much information available, because I just thought private companies, you don't know anything at all about them. And, it's a point of pride for us here at Equityzen that we spend a lot of effort to organize, to structure this information, and anything and everything that is publicly verifiable. We go through many iterations to try and make sure that it's available to you, the accredited investor, so you can decide whether or not this investment makes sense for you.
How about valuation?
So the valuation is something that starts off using the cap table, using every single series of shares that the company has issued, including the last one, and exactly what rights they have and what the price is. And that's the starting point that we show both the buyers and the sellers. And then what ends up happening is that the buyers submit price levels at which they're interested. The sellers submit price level at which they would be interested to sell. And then we work like any other matchmaker does. And we say, okay, we have this much demand at this price. We have this much supply at this price. Okay, great. Let's get these folks together. Let's conduct a transaction. And so the ultimate price is definitely determined entirely by supply and demand. What is true is that we provide a starting point using which the buyers and sellers can at least have a point of reference. Because these are private companies, because you can't just look it up on Yahoo Finance, we give folks a starting point to say, okay, the implied valuation of this company is $700 million. That means that the share price we're talking about is worth $8.49. And you're welcome to submit your own, level of interest at which which could be $50,000 at $8 or $100,000 at $7.99 or what have you.
Okay, so you can bid. I was under the impression that there was a fixed cost, but maybe that's not the case. You bid on it. You bid on it.
Yeah. So what ends up happening is that a lot of the we collect data on every single indication of interest from buyers, indications of interest from the sellers. And then, this order book starts to form where you have all the points of demand and all the points of supply. And then where there's overlap between the two is where we say, okay, at this price, at $8 a share, there's enough people who are going to have their interests met on the buy side and the interest met on the sell side. And then we use that price to say, all right, here's what's going to happen. The market clearing price right now is $8. And if you want to invest in it, then you can at $8. And if not, then we can wait to see if it drops back down to 8.
I see.
And maybe that's the fixed price you're referring to.
Yeah, I think that's right. So I think it is set for a period of time, and then I'm guessing it just it will drop if there's not enough buyers. This is kind of what you're saying, right?
That's exactly right, and it could go up if there's less supply than there is demand. That's exactly right. Is
there a secondary market to that market? In other words, somebody buys so much shares of Lyft, and then it's still not gone public after 2 years, and they say, maybe I want to sell it, is that kind of your final sell at that point?
No, I wouldn't say it's our final sell. We've definitely helped folks complete a round trip where they say, okay, I'm ready to buy this, into this company, and they do, and that was in 2016, and now it's 2018, and they say, well, I'm past the mandated, the required period of holding on to it at least for 1 year, which is mandated by the SEC, Rule 144. But then you say, I bought it at 16 bucks and I see it's trading at 23 bucks. And yeah, that's a pretty good gain. That's a 50% gain in 2 years. And I think I'm happy with it. And so just as easily as you bought with the clicks, with clicks of with a few clicks of a mouse, you can actually also indicate that you're ready to sell. And then, as long as there's a willing buyer at a willing price, we'll happily provide you liquidity as well. And so I guess the point is we really are trying to make what is a very illiquid market, these private share markets. We're trying to infuse liquidity into it. And so the shares that you as an investor may be purchasing could be from a first-time seller, or it could be from an investor that bought it 2 years ago, and they're happy with the return now.
Yeah, that makes sense. So I know we kind of alluded to this before, but can you give us a sense, and again, I know it's really one of those things where you just don't want to talk about these results because it's past performance, but when you go from that phase of pre-IPO to IPO, what kind of outcomes have you seen? Just if you could just give us a couple examples, just to get a sense for what kind of pops that sometimes are possible when you go through this transition of private to public.
Yeah. You're absolutely right that we have to be careful for regulatory reasons not to overpromise any of this. But, here's what I can share with you. In fact, we put together a case study on Redfin specifically. So I feel that a real estate interested audience will actually find this pretty interesting. Redfin's a company that's been around since 2004. They raised a bunch of capital all the way, for 10 years, 11 years, all the way through 2015. And in 2016, Equityzen helped, the company with their liquidity needs. We helped conduct, at least one transaction that we talk about here in the case study at right about what looks like between $12 and $14 a share. And then by the time the company went public, the company actually, the IPO priced in at $15 a share. So already you're starting to see that by the time, most outside investors got a chance to invest, it was already higher than the price private market investor had paid. Oh, I take that back and I'll confirm that the purchase price on Equityzen's platform was actually $12. Mm-hmm. So $12 is where an investor invested in Redfin equity at, well before the IPO. The IPO price at 15 bucks. At $19.56 is the earliest that any outside investor could have purchased a share. This is called the open price on the IPO. Right. If you were one of the lucky people that got their bid filled immediately upon the market open, you would have paid 19 bucks and 56 cents. And by the end of the first day, the shares closed at just a little bit above $25.
Yeah.
And so for the folks that invested on Equityzen's platform well before the IPO, held on to it while the company was still private, they saw 115% return on their investment. Now, once again, these are still risky securities.
Sure.
It's possible to lose money as well as it is to make money. So I want to be very.
Oh, don't worry. We even talk about cryptocurrency on this show, so you have nothing to worry about.
Well, in that case, I'll tell you that these are in fact real companies with real business models. But yeah, I mean, I think that's at least illustrative.
Yeah, no, that's really helpful actually, because that's kind of what I was getting at. Now, I'm generally not, like a stocks and bonds guy, but I do invest in IPOs and pre-IPOs, specifically in the Toronto stock market in the junior mining sector, and so I know what kind of results you can get. So I was just curious, if those were the kinds of things we were talking about here, and it sounds somewhat similar to that. Now, let's talk a little bit about. I want to shift a little bit here. Oh, by the way, before we move on, is there typically a lockup of these equities after the IPO for these owners?
So, anyone that purchases shares before the IPO gets treated as if they were any other shareholder. And this means that there's typically a 6-month or 180-day lockup after the IPO, at which point the shares are delivered straight to a brokerage account to the accredited investor that had purchased it in the first place. And many times the folks hold on to it because it's a 10-year buy for them. And sometimes the folks say, you know what, I'm happy with the performance so far. I've passed a year, and according to Rule 144, I can sell, and so I'll go ahead and
Yeah.
sell. So there's the lockup. And once again, this is an offering, to invest in individual private companies
Yeah.
that Equityzen makes available to all accredited investors specifically.
Yeah, that's helpful. Okay, so shifting a little bit, I saw a video of you. I think maybe you were on CNBC or something, one of those cable financial networks where you were talking about potential changes to the accredited investor laws. I just saw that literally, about a couple hours ago. And I was curious about that. What do you know about that? Is that going to happen?
Well, there's certainly been more attention paid here than there was before. I think with a lot of the rise of cryptocurrencies, and the just the staggering amount of dollars that are flying into it, there definitely has been a bit of a slowdown in the reform of the definition of the accredited investor. Here's what is true, though. I think the securities laws that we're talking about are really in place to protect the consumer. And
Mm-hmm.
it can seem frustrating to a lot of folks, including ourselves at some point, when we say, oh man, but we know this person's a sophisticated investor. They know what they're talking about. Why can't they invest? And the reason is that the SEC has come out and said the definition of an accredited investor is someone that makes 200,000 a year in income for the last 2 years, or they have $1 million or more in terms of investable assets, not counting the value of their house. And there's a few other ways in which you could be accredited. But the point is this, is that the SEC says, well, for now, we're going to make it so that because these are very risky investments that we're permitting people to engage in, we want to at least make sure that whatever amount that they invest is not going to completely wipe them out. It's not going to cause them to lose their home or anything like that. And so the the approach they've taken is to draw broad strokes and say, well, you must be wealthy enough so that even if you were to make a losing investment, you're not going to be out on the street. And I think that there's definitely interest in these reforms and defining an accredited investor, partially also by potentially testing for their knowledge, their education, the fact that it seems a little odd that a financial advisor can advise other people on their investments, but may not be an accredited investor themselves, and so maybe they couldn't apply the same knowledge for their own wealth creation. And I think that that's something that we continue to follow closely. And here at Equityzen, even for folks who are not accredited investors, we put out a lot of educational content, just like this part of the podcast here is to make sure that people that may not be accredited today doesn't mean that they won't be accredited tomorrow. And it certainly behooves the listeners and as many people as we can tell to at least keep in mind what some of the options are. Once you do become accredited, what are going to be some investing options that are available for you so that you're not starting from scratch at that point.
Yeah, yeah. I find it very frustrating too because I have a number of physicians, for example, who listen, and some of them are new. And what happens is, they're coming out, they're making $400,000 or $500,000 in their first year, and they're in practice for a year, and they still don't qualify, even though very few people would argue that they've got the money to be able to invest $25,000 to $50,000 in a private placement. So some of these kind of these bars that are set are kind of silly. But let me ask you a question that might seem a little bit of odd or curveball. But have you considered the potential role? We talked about cryptocurrency, but that distributed ledger technology in general, blockchain technologies, how they might affect your kind of business model in the future? Just because, again, it's sort of, the way things are going to be done maybe 20 years from now could be very different, right? Where companies may be issuing, may not be going through large banks and doing IPOs anymore. Is that on your radar at all, or is that just something that I'm thinking about because it's something I'm interested in?
Oh no, absolutely. It's something we pay a lot of attention to. In fact, we think that there are many ways that, the ledgering system, the blockchain, the underlying technology could actually play very innovative roles here. I mean, here's one way to think about this. One of the things that we invest a lot of our energy in is conducting due diligence. When a shareholder says they have, 1,000 shares of some company, how do we verify that they actually own the shares? Can we confirm with the company that these shares haven't already been sold to anyone else, and so on and so forth? It's not unlike the titling system in real estate.
Yeah.
The ledger can be a great technology in order to try and build in verification so that due diligence is at least easy to conduct, if not entirely, a natural side effect of you still having that asset in your digital wallet.
Yeah.
That's just one way in which we could make this. We could implement the blockchain technology. We've also, I should point out, that we've worked with other cryptocurrency or blockchain technology based companies, and we've conducted more traditional share transactions for some of the larger players in that budding industry. And I think that just goes to show that it's not just you and me here, Buck, but also the accredited investors that are listening to us right now and that are on Equityzen's platform right now, that are also paying attention to the various possibilities that this technology has to offer, to finance in general.
Well, this has been really interesting. Again, the site is equityzen.com. Atif, thanks so much for being on Wealth Formula Podcast.
Buck, it was a pleasure. Thank you very much.
We'll be right back. Welcome back to the show, everyone. Hopefully you learned something there. I certainly did. And you know what? I am happy to invest in businesses that are not driven up in price just by emotions of the stock market. That whole irrational public market. If you can get in early and take advantage of everybody else's irrationality by buying a company at a real value that makes sense and then waiting for it to go public, why not? It might be worth it. Now listen, check that out again if you want at equityzen.com. I do want to remind you, and I want to make this a strong call to action, so listen to me here. I want to remind you that my course, Your Roadmap to Real Wealth, is live, and so is Wealth Formula Network. And if you get in before Saturday, April 14th, you will get a free 1-hour coaching and strategy session with me. Like I said, I don't take this lightly. I think it's a very valuable exercise. And being part of that whole Wealth Formula community going forward could be one of the better investments that you make in your life. So definitely check it out. Go to wealthformularoadmap.com and sign up. And that's it for me this week. This is Buck Joffrey signing off.